Good morning, everybody. Austin here. Today, we're talking about Ford's warning to investors. They just said there's going to be an extra $1 billion in supply chain costs during the third quarter. And you can see right here, the stock is down about 5% before the market even opens today. So this is an example of why Tesla is dominating the auto industry and especially the EV industry, which is what everybody's moving to, right? They have such a head start on production and technology and self-driving and all of these different things. And we're really starting to see the advantages of that as Tesla is actually scaling production up, which I'm going to share some examples of in just a minute, while these legacy automakers are having trouble making this transition because of the way they produce vehicles, the way their inventory works, the way their supply chain works. They can't keep up with Tesla, and Tesla's going to keep extending their lead. So on Monday, they warned investors that the company expects to incur an extra $1 billion in costs during the third quarter due to inflation and supply chain issues. They said supply chain problems have resulted in parts shortages affecting roughly 40 to 45,000 vehicles, primarily high margin trucks and SUVs that haven't been able to reach dealers. So they are expecting to complete and deliver the vehicles to dealers in the fourth quarter, and they're still projecting 2022 adjusted earnings before interest and taxes between $11.5 billion and $12.5 billion. And so they think the third quarter adjusted earnings before interest and taxes are going to be in the range of 1.4 to 1.7 billion. They said executives are going to provide more dimension about expectations for full year performance when it reports third quarter results on October 26th. So we'll see how those results go. All right, now let's jump over to Tesla, right? Ford is having these supply chain issues. They're slowing deliveries. They're saying they're having trouble sourcing, parts for their vehicles. Here's the recent headlines for Tesla. Tesla aims to double sales in Germany. Tesla adds 40 supercharger stations in mainland China in August, completes production capacity expansion at Shanghai plant. Here's a negative one. This is just an opinion. Tesla's inroads to China offer challenges. Okay, that's an opinion. These are actual things that Tesla's doing right now. City just picked Tesla. Okay, whatever. But then Tesla further improves delivery cycle in China. So Tesla's delivery times and wait times are getting shorter. They're actually producing vehicles kind of ahead of expectations, right? Real quick, if you don't know me, I'm Austin. I'm building a $1 million portfolio right here on YouTube. We started at $10,000 on February 22nd, 2022. I'm adding money over time, sharing every step of the way, my buys, my sells, my wins, my losses, all my performance, everything right here on YouTube. If you like this kind of stuff, do me a favor, like this video so more people find it, and then subscribe to the channel and turn the notification bell on so you never miss an update. I do full portfolio reviews on Fridays. Okay, here is my portfolio. I own Snowflake is my largest position, Rocket Lab, CrowdStrike, Datadog, Meta, GitLab, Tesla, The Trade Desk, Cloudflare, Mongo Database, Bill.com, Shopify, Airbnb, Mercado Libre. If you like these stocks, these are the types of growth stocks I generally cover, as well as some other stuff like Ford issues sprinkled in between. But full disclosure, I do own Tesla, so obviously I'm a Tesla bull. Got $7,152 invested in Tesla. And so that means I own about 23 shares. Average share price is $280. And the total cost is $6,500. Okay, let's jump back into the comparison. Tesla versus Ford. So what am I saying? I said Tesla's going to keep dominating Ford. And what I mean is the stock price change over the last 5 years. This is Weijii, WIIJII.co. I'll put a link down in the description. Tesla over the last 5 years is up 1,200%. Ford is up 27%. Okay, I'm not saying that Tesla's going to keep gaining 1,200% every 5 years by any means. But I like to see a history of companies that are outperforming, and Tesla certainly is. Ford certainly is not, and I don't see any reason why that's going to change. Now, both of these stocks are down from their 52-week highs. Ford is down about 42%. Tesla's down about 25%. Now, here's the thing. This is the thing that people cannot get over. Tesla's market cap is $965 billion, almost a $1 trillion company, and people think that this is all just smoke and mirrors. There's no reason an auto manufacturer like Tesla should be have a value of $1 trillion. We'll get into that in just a minute. Whereas Ford is valued at $61 billion. I'm going to talk about why I think there's the big difference here. Great, and this is where Tesla really starts to outperform and where I think they're going to continue to outperform. They are a much more profitable business, and as Tesla earns a portion of revenue potentially from software, maybe software subscriptions, like a subscription to full self-driving or other things. They have a lot of optionality in the business. They're actually going to get more profitable, in my opinion, as they scale. But even at their current state, with a lot less total revenue than Ford, they're actually earning more EBITDA, earnings before interest, taxes, depreciation, and amortization. So Tesla's at 14.3 billion, which is about a 21% EBITDA margin, versus Ford that's at 12 billion with about an 8% EBITDA margin. So they've got almost 3x the EBITDA margin that Ford does. And so when we look at net income, Ford was at 11.7 billion in net income, and Tesla was at 9.5 billion for the last 12 months. And again, Ford has significantly more revenue than Tesla, but Tesla is almost pulling in the same amount of net income. That shows you the differences between the profitability of these businesses. Okay, let's take a look at the income statement for these two different companies. We're going to look at Ford, and then we're going to look at Tesla. This is using Everything Money. It's a nice site. I like the layout. It's pretty usable for users. This is going back to 2012. So they had $133 billion in revenue in 2012. In 2021, they had $136 billion. So by over 9 years, they haven't grown revenue essentially. Even if we go before COVID, they had 155 billion in revenue. That's not very impressive revenue growth for 7 years, right? And so here's the problem. Their revenue growth isn't growing that fast. And they're also not showing that they're getting more efficient with scale. So their cost of goods sold still stayed at about the same ratio as revenue, right? And so what that comes out to is not really earning any more gross profit, which is what drives, the value and the bottom line that businesses are worth in a lot of ways. They really didn't increase gross profit that much from 2012 to 2021. It was 17 billion back in 2012. And they're up to 21 billion in 2021. Let's jump over to Tesla and just look at the difference in pretty much all of the metrics of this business, right? Since 2012, revenue has grown from 413 million to 53 billion dollars, okay? This explains a lot of the reason. I mean, this whole time, everybody was saying Tesla was a fraud, they're going to go bankrupt, which there were risks that they were going to go bankrupt back here. I mean, they were basically operating on a quarter-to-quarter survival basis, right? But they've accomplished a lot. I mean, they built out the supercharging network and essentially forced the EV industry forward, right? And they've grown from 413 million revenue to 53 billion. So yes, Tesla has gained a lot in the past 9-10 years. I think a lot of that was deserved. It took a lot of risk to do it, obviously, and risk for investors to be invested. The question is Tesla still a good buy moving forward, which we'll talk about in just a minute. So looking at gross profit, again, from 30 million to 13 billion. And so now we're seeing net income that's gone from negative 396 million to $5.52 billion. What I want to do now is I want to do a price model, essentially a low, a medium, and a high for Ford and for Tesla. So to get that, we need revenue growth estimates, we need profit margin, we need free cash flow margin, price to earnings, price free cash flow, and then desired annual return. So to get that, we're going to use a mixture of what the company has historically done and then what analysts are expecting in the future. And so for Ford, if we jump over to Ticker has the analyst forward estimates in here, and what it can do is we can sort of average it out, right? So we've looked at what analysts expect for 2022, 23, 24, 25, and 26 for revenue growth. And they're coming in at about a compound annual growth rate of 5%. But look here, they're expecting actually negative growth in 2025 and negative growth in 2026. Let's look at EPS growth. So again, they're actually expecting for 2022 about 29% earnings per share growth, but then negative 3.3%, negative 2.8, 13, and 19. Okay, so essentially going from $2.06 in 2022 to $2.62 earnings per share. It's about a 10% growth rate. Okay, and so they're expecting net income margins in 2026 of about 6.6%. Okay, so we're building out a 5-year model for Ford. We looked at revenue growth rate. Analysts are expecting about 5%. They're expecting about 10% EPS growth rate over the next 3 to 5 years. And so we're using those numbers as kind of like the baseline for building this. Now, also, if we look at the last 10 years and the last 5 years, they actually have negative revenue growth rate. So we're taking that into consideration and we're using 0% as the low side just to see. Maybe we enter a recession, a longer term recession, and they're not able to grow revenue over the next 5 years. Let's build that into the worst case scenario. Middle is 2.5%, and then high is kind of in line with what analysts are expecting, 5% revenue growth. Profit margin 3, 4, and 6. That's kind of just based on historicals plus analyst expectations. And I think that 6 is actually pretty generous for profit margin, considering over the last 10 years they're at 3.7%. Free cash flow margin, 10-year average has been 7. 1 year is 4, so we went 4, 5, 7. Price to earnings ratio 4, 6, and 8. They're at 5 right now. And then just looking at this historical averages, I think 4, 6, and 8 is a decent range. That's all we're doing here is building a range and setting our expectations. Price free cash flow 5, 7, and 9, and then our desired annual return is 10%, 10%, 10%, because we can get 8 to 10% owning an index fund. And so right now, what this is telling us is if we think that any of these scenarios are true, if we think low and middle on an earnings basis, price earnings basis is true, this stock is overvalued right now, and we would actually want to not own the stock until it got under 12 for our mid scenario and under 6 for our low scenario, which is down 50% from here. High, it's saying this thing is worth 23, which seems a little excessive to me, but that would be a double from here. So maybe an investor likes this and you want to dig in to Ford and look at more. I'm actually not going to set a price warning on this because I would never own this company. Actually, I take that back. I'll set a high price warning, and I want to know if it gets above 23. It'll go on my watch list. And if I see that, then I'm going to just come out and admit I was wrong about Ford's stock and my valuation on it was completely wrong. So I'll set that for myself, even though I'm not going to buy the stock. It's just not a stock I want to own. All right, let's jump over and do the same thing with Tesla. Okay, if we look, revenue growth has been insane. Profit margin is improving versus getting worse, and then free cash flow margin as well. The PE ratio is the ridiculous thing, and that's where people think that they would never want to buy. So let's try to build out some reasonable scenario for Tesla. It's going to be hard to do. Okay, so if we look at analyst expectations, they're actually expecting on average about 29% revenue growth over the next 4 or 5 years. They're expecting 13% net income margin in 2026, and they're expecting about 26% earnings per share growth. Okay, so this is looking 5 years out. We went revenue growth low, 23%, which is about 20% lower than what analysts are expecting. Mid, 29%, and high, 32%, which is about 10% higher than what analysts are expecting. Profit margin 13, 15, and 17. I think that this business could actually get more profitable over time as they expand and potentially get into more profitable areas of business outside of just auto production. Free cash flow margin, again, same deal, 12, 15, and 16%. All right, price to earnings ratio currently at 101. I'm going to drop it by about 70% for the low scenario down to a PE of 30. Going to drop it by 50% down to 50, and then going to drop it by about 40% down to 60 for the high scenario. Okay, and this is over the next 5 years, so pretty significant drops to the price to earnings ratio. Price free cash flow, I just left them at the same thing, and then we're still looking for that 10% annualized rate of return. Let's hit analyze and see what comes out. And so according to these scenarios, which you probably don't agree with, but if you think that the middle scenario is in line, then this thing is a buy under 346. Shares are currently at 306. If you think the high scenario is likely, then on a PE basis, multiple of earnings, you would be willing to buy it under 521. If you think that the low scenario is the most likely, then you're looking at about 50% downside from here. So that would be 23% revenue growth, 13% profit margin, 12% free cash flow margin, 30% or 30 a PE of 30. And so the stock's already at 306, so it's in my middle price range. What I want to do is I want to get alerted if this thing gets above 521, then I'm going to start to think it's very overvalued and I should consider trimming my position because, like I said, I already own the stock. Let me know in the comments what you think of this analysis and if there's any other stocks you want me to analyze. If you want to track my portfolio and get SMS and text updates, the best place you can do that is Savvy Trader. I have my portfolio on there. The link is down in the description. You can follow along, but it shares all my holdings. It shares my performance. You can look at the performance versus the S&P 500, which I am losing. And again, this started on August 29th. That's when I started the portfolio on here. This is different than when you see the performance from my M1 portfolio, which is my actual brokerage account that I share in every single video. That started February 15th. So if you see the difference here, that's why you see the difference. But now I can compare myself to the S&P 500. I'm down 5% since August 29th. S&P 500 is down 2.3. And then the cool thing is you can see all of my transactions, which this week I bought more shares of Datadog for $91.74. Anyways, follow along with the portfolio if you want to down in the description, and do me a favor, like this video, subscribe to the channel. It really helps us grow.